The student loan trap. How $1.7 trillion in debt is destroying a generation. $1.7 trillion. That is not the national deficit. That is not the cost of a foreign war. That is the total amount Americans owe in student loans right now. It is the second largest category of consumer debt in the country, behind only mortgages, and ahead of credit cards, auto loans, and every other form of borrowing combined. 43 million Americans carry this weight, and for most of them, there is no clear path out. How did we get here? How did the promise of education, the one thing every generation told the next would guarantee a better life, become the very thing destroying it? Stay with me, because this story is darker than you think.
It starts with a policy change that most people have never heard of. In 1965, the federal government began guaranteeing student loans through the Higher Education Act. The idea was simple and well-intentioned: make college accessible to everyone, regardless of income, by removing the risk for lenders. If a student defaulted, the government would cover the loss. On paper, it looks like a win for everyone. Students got access, banks got security, and society got a more educated workforce. But here is what that guarantee actually did. It eliminated the market's ability to say no. Banks no longer needed to assess whether a student could realistically repay the loan. The government was backing it, so they approved everyone, for everything, at any price. And universities noticed immediately. When students can borrow unlimited amounts, there is no reason to keep costs low. Tuition at public four-year institutions has risen over 1,200% since 1980. Not 12%, 1,200%. Adjusted for inflation, it has still nearly tripled. The universities built luxury dormitories, massive athletic complexes, rock climbing walls, lazy rivers, and administrative bureaucracies that ballooned far beyond anything related to education. The number of university administrators in America has grown at 10 times the rate of faculty since 1975. At many institutions, there are now more administrators than professors. The money was flowing freely, and no one in the chain, not the government, not the banks, not the schools, had any incentive to turn off the tap.
Now here is where it gets predatory. The student loan system was designed with one feature that exists in almost no other form of American debt. Student loans cannot be discharged in bankruptcy. Think about what that means. If you start a business and it fails, you can declare bankruptcy and eventually rebuild. If you buy a home you cannot afford, the bank takes the house and the debt is resolved. But if you borrow $80,000 for a degree that leads to a $40,000 salary, you carry that debt until it is paid or until you die. This was not always the case. Student loans were dischargeable in bankruptcy until 1976, when Congress began restricting it. By 2005, the protection was essentially eliminated for both federal and private loans. Who lobbied for that change? The lending industry. The same institutions making billions in interest payments from borrowers who cannot escape. Let us talk about the repayment illusion. The government offers income-driven repayment plans that sound compassionate on the surface. Pay only 10 or 15% of your discretionary income, and after 20 or 25 years of payments, the remaining balance is forgiven. Sounds reasonable. Until you look at the math. Under many income-driven plans, monthly payments do not cover the interest accruing on the loan. So while you are faithfully making payments every month for 10 years, your balance is actually growing. You started with $60,000 in debt. A decade later, you owe $80,000. This is called negative amortization, and it is by design. And that forgiveness after 25 years, the IRS treats the forgiven amount as taxable income. So if $200,000 is forgiven, you receive a tax bill for roughly $50,000, a bill most borrowers cannot pay. The system creates the illusion of relief while ensuring the debt remains profitable for decades.
The human cost is staggering. Research from multiple institutions has documented the psychological damage. Student loan borrowers report higher rates of anxiety, depression, and chronic stress than the general population. They delay major life milestones, marriage, home ownership, having children, by an average of 7 years compared to debt-free peers. A study from the National Bureau of Economic Research found that student debt reduces the probability of home ownership by age 30 by approximately 15 percentage points. For an entire generation, the American dream of owning property has been replaced by the reality of monthly loan payments with no end in sight. And the weight falls disproportionately on those the system claimed to help. Black graduates carry an average of $25,000 more in student debt than white graduates. 4 years after graduation, Black borrowers owe on average 112% of their original balance, meaning they owe more than when they started. This is not a system that creates opportunity. It is a system that entrenches inequality while wearing the mask of access.
So, what do you do if you are caught in this trap? 3 strategies that can actually make a difference. First, attack the principal aggressively. Any extra payment you make should be directed specifically to the principal balance, not future payments. Call your servicer and explicitly instruct them. This is the single most effective way to break the cycle of negative amortization. Second, explore employer repayment programs. Since 2021, employers can contribute up to $5,250 annually toward employee student loans tax-free. Not enough companies advertise this benefit, and not enough borrowers ask for it. Third, if you work in public service, pursue public service loan forgiveness seriously. After 10 years of qualifying payments while working for a government or nonprofit employer, the remaining balance is forgiven tax-free. The program was mismanaged for years, but recent reforms have dramatically improved approval rates. None of these are perfect solutions. The system itself needs structural reform. But waiting for Washington to fix this is not a strategy. You have to work within the reality that exists while pushing for the one that should. The student loan crisis is not an accident. It is the predictable result of removing market discipline, guaranteeing profits for lenders, and trapping borrowers in debt they cannot escape. Every player in the system, government, universities, loan servicers, is incentivized to keep the machine running exactly as it is. Understanding how the machine works is the first step to escaping it, and sharing that understanding with others, with your siblings, your children, with anyone considering borrowing 6 figures for a degree, is how we begin to change the equation. Subscribe to Wealth Unveiled for more on the financial systems designed to keep you in the dark. We publish every week, because knowledge is the one asset they cannot repossess.